Hi everyone, I am Constance. Today we are going to talk about financial ratio analysis. And in this video, I will show you how to calculate the main financial ratios. So what is financial ratio analysis? Financial ratio analysis are used as a management tool to review trends and compare periodic results or compare entities with each other in a similar industry. Without ratios, financial statements will be uninformative. There are five main categories of ratio analysis used to evaluate the financial health of any company, which are shown below. The first one is profitability ratios. This measure management's ability to control expenses and to earn a return on the resources committed to the business. The second one is solvency or liquidity ratios. This measures a company's ability to meet its current obligations. The third one, efficiency or turnover ratios. It provides information about management's ability to control expenses and to earn a return on the resources committed to the business. The fourth one, called capital structure ratios, measure the degree of protection of suppliers of long-term funds and also aid in judging a company's ability to raise additional debt and its capacity to pay its liabilities on time. The final one of the ratios is the shareholder ratios. This ratio is used by anyone interested in an investment in a company because it indicates how well a company is performing in comparison to their share price of its shares, earnings per shares, dividend cover, and price earning ratios. In business, profits represent the company's reason for existing. And this is why we should start this session with profitability ratio. So what is profitability ratios? The profitability ratios measure management's ability to control expenses and to earn a return on the resources committed to the business. It indicates the gross margin generated for every euro in net sales. It shows the profit generated for every euro in net sales, and it indicates how much net income was generated from every euro in average total assets invested in the business. So on this page is a financial statement. With that, I meant that I've put the balance sheet and P&L together. So on the left-hand side is the, for example, total assets, current liabilities, total shareholders' equity, long-term liability, total sales, gross profit, profit before interest and tax, profit before income tax, and then tax expenses, and then we have the net profit. And the analysis, I'll be using mainly the 2019 figures, just that you know. And so when I show you the analysis, you'll be able to relate to the figures that is shown right now on the financial statement. So now we're gonna calculate the actual ratios, and on this page is one of the critical equation of profitability ratios, and that is return on capital employed. So what is return on capital employed? It is by far the most important of all profitability ratios, as it encompasses all the other ratios put together and is an adequate return on capital employed, which is why individual investors invest their money in the first place. So to calculate it, you take EBIT, divide by return on capital employed, multiply by 100. So I've put the equation there, and return on capital employed is based on the financial statement from before, is 51,686 divided by 699,276 multiplied by 100 to give you 7.4%. With this result, what it means is that a return on capital of 7.4% means that for every euro invested in capital, the company generated 7 cents in operating income. The second analysis on the profitability ratios is the gross profit margin. This ratio indicates the relationship between net sales and the cost of goods sold. This ratio should be actually compared with prior periods, as it may indicate insufficient volume and excessive purchasing or labor cost. So to calculate this, you take gross profit divided by net sales multiplied by 100. So in our example from the financial statement, that would be 100,845 divided by 117,197 multiplied by 100 to give you 86%. So with this result, it means that for every euro generated in sales, the company has made 86 cents left over to cover the operating cost and the profit. Net profit margin is another ratio to work out the profitability ratios. This ratio is a measure of net profit in euro generated by each euro of sales. To calculate this, we take profit after tax divided by net sales multiplied by 100. So in our financial statement figures, the net profit margin was 30,991 divided by 117,197 multiplied by 100 to give you the 26.4%. So with this result, it means that a 26% profit margin indicates the company earned 26 cents in profit for every euro that it collected. Return on assets. This ratio measures the company's ability to utilize its assets to create profits. To calculate it, you take net profit divided by average total assets. So you take beginning assets balance on the balance sheet plus the ending, and then add it together, divide it by 2 to get the average, and then the result, you divide the net profit by the result and multiply by 100. So to sum it up, on the financial statement, we had a net profit of 30,991 divided by 1,614. Multiply by 100 to get 3.1%. So this means that in 2019, for every euro in assets, the company earned 3 cents in profit. This is another investment ratio, return on investment. The ratio measures the income earned on invested capital. To calculate it, you take net profit divided by the total of equity and long-term liability multiplied by 100. So in our financial statement, the return on investment was net profit was 30,991 divided by 699,276 multiplied by 100 to give you 4.4%. So the result indicates that for every euro invested, the company earned 4 cents in profit. The ratio is extremely useful for measuring the efficiency and success of investments and helps companies to make future business decisions. Return on equity or shares. This ratio is quite important for shareholders or anyone who is trying to invest in a business. And you can take the past information on the internet for any registered businesses to be able to analyze it and see whether you are really gonna make some profit when you sell your shares out of that business. So return on equity or shares. The ratio indicates the income earned on the shareholder's investment in the business. To calculate it, you take net profit divided by equity multiplied by 100. So return on equity, net profit is 30,991 divided by 198,413 multiplied by 100 equals 15.6%. So the return on equity on this measures profitability using resources provided by the shareholders and the company. And with that in mind, it means that the high return of 6 cents on assets shows that the business was able to successfully utilize the resources provided by its equity investors and the company's accumulated profits in generating this income. So I've pulled together a summary of the elements of profitability ratios. So number one is return on capital employed, gross profit margin, net profit margin, return on assets, return on investment, and return on equity or return on shares. So we've come to the end of the profitability ratios. I hope you like what I put together. I know it's not perfect the way I've explained it, but if you go through the whole presentation, it will make sense to you. And I'm sure you will like it because I think, as I am a chartered accountant, I can only put it the way I present it to people who are not accountant even. Yes, if you like it, please do not forget to subscribe, and then of course leave a comment and thumbs up. And I'll be trying to keep updates, providing you with further information, because as I said earlier on, that there are 5 financial ratio analysis. So today, the profitability ratios is the first one. So soon I will follow by providing you with the other ratios. And so thank you for watching my videos, and yes, goodbye.